Hi guys, today we covered a very sophisticated but a rather simple topic, investing in bonds. We covered their definition, of course, the difference between bonds, bills and treasury notes, how to invest in them, factors affecting them, what are the expected liabilities in regards to taxation, of course, what are the movers, the guarantees involved with it. It will be very informative. I was joined by Rufas. I hope you get to learn one or two things. And I hope we'll get more questions. And more importantly, remember to share, like, and subscribe FX Pesa on all DSPs and wherever you listen your podcast from.
It was a very interesting session. Make sure that you listen to it and give us your feedback. So for those who are looking to open an account with FX Pesa, whether it's a demo account or a live account, find the link attached below and follow through the journey. We have live classes happening on our YouTube channel.
Hey guys, I hope you are having a wonderful day wherever you are. Yet another episode of Bullish Banter, and tonight or today, I hope you learn one or two things about some complex investing products, which I think is kind of gaining traction in the market. I don't know what you think about that, Rufas.
Yes, the topic for today is basically investing in bonds.
Yeah.
Traditionally, retail investors have thought of them as complex, out of reach, but today we are doing the job of simplifying bonds so that you guys can understand them, and when you're making a decision to invest in bonds, you'll know what you're getting into.
Yeah. Obviously, we just dive into it. How are you doing?
I'm doing fine.
Yes.
Yes.
Recently, I think I told you that I'm trying to exit from, investing in local equities in Kenya. I think the correct words were, if you want to put your money somewhere, find the juiciest stocks. I think my portfolio down now in NSE is down at least around 10%. And the overall index is like down negative year to date. NASI, I think both the NASIs are around 18 plus. So obviously, with that in mind, it gives you an idea as an investor, like what else can you do to avoid the negative, returns or rather negative appearance of the portfolio. So I've been looking at bonds. Globally, they have been doing well. I think in US, 5%, which is way above. And in Kenya, we are, I think, approaching almost 20%. And for the average investor who's looking to diversify, you've made your money from FX or other investment, you're trying to look for somewhere else to park it kidogo. What is a bond?
A bond, in simplest terms, is basically a loan that you give to the government, and you expect the government to pay you back with interest.
Yeah.
So when you think about a bond, always think of it as a piece of paper that the government basically gives you. You give your money to the government. Bonds can be different. There are also what we call corporate bonds, where you basically buy debt in a company.
Yeah.
And then most generally, when you talk of bonds, the first thing that comes in mind is treasury bonds, where you're basically lending money to the government over a specified period of time, and then the government pays you what we call yield. So the yield is payable in different periods. So some yields will be given after every 6 months, others after 1 year.
Yeah. To put some context into that, I think there is the treasury bills, which typically do not exceed 1 year in terms of you being paid the maturity. And one interesting fact I think I've learned over my last couple of months trying to understand it and trying to see how can I get in there. We have seen, so this is how I look at it. Treasury bills for somebody who is starting suits you very well because it's 3 months. You can lock in your account. You can lock in your money there. Yeah. Even though it's expensive to buy in, at least for if you are looking to pack away, let's say 100,000 shillings for like 3 months, it gives you can buy it on discount.
Yes.
And I think from the latest data, which is normally posted by CBK on their website, you're able to see you're buying it at around 92 shillings or 92 shillings on 100, let's say 100 shillings contract. To put it like that.
Yes.
And then secondly, they have very good rates. I think that we are talking about 14%, and they are being paid in regards to yield. They are paid after the 3 months when they mature.
Yes.
Now, I think for context, for those who are looking to differentiate between the bills and the bonds, Now,
So there's basically three classifications for bonds. We have the very short term. We call them treasury bills.
yeah,
There's treasury notes. Then there's treasury bonds.
okay,
So very short term between 0 and 1 year is the treasury bills. So for treasury notes, it's usually a period between between 1 year and 10 years. And anything between 10 years and higher is basically regarded as a bond.
Yeah.
But sometimes in reporting, you can find the terms being used interchangeably.
Okay.
And before we proceed further, I'd like to thank you. Congrats for getting out of that NSC craziness. I knew at some point you would get out of it.
Yeah.
There are way better companies out there that are doing well. I don't think it makes any logical sense to basically limit yourself to the stock trading in the NSE when there's other companies doing way better out there.
Yeah. Now, I think, yes, it is. You see, if you are losing 10% and there is somebody offering you 10, let's say 14% and above, and to some degree tax-free or tax-efficient to your investments, and most importantly, cost-efficient, I think that is a logical choice to make. Of course, I stuck my neck out for Kenya to some degree patriotism, but at some point patriotism does not pay your rent. So reality kicks in and then you choose it.
Speaking of costs, there's quite an interesting article I saw today for concept, for just to put it in the right perspective. Today is the 20th of September. There was this article on Business Daily basically saying that the newest platform by the Central Bank of Kenya is called DAO CSD. It's allowing people to invest directly in bonds, that is retail traders. And when you look at the bonds offering, the minimum you can invest is about 50,000 shillings. If you're doing the M-Akiba, the minimum is 3,000 shillings, which you can do using M-Pesa. So for the DAO CSD, previously, you'd have to go to the central bank hall, then you'd pay in cash, get your bond, or you'd basically deposit via a banker's check. But now they have limited those investment routes. So now the only way you can invest in these bonds is by using commercial banks. So a commercial bank is literally charging somewhere between 500 and 1,500 for RTGS transaction. So if you're going for a bond, let's say with a minimum amount, which is 50,000, and then you pay 500 bob, then you've already lost on 1% of the income from that bond because of transaction cost. So it's becoming quite punitive for the retail investors who are going for smaller amounts. So it was a key concern. Why is the central bank basically punishing people who have smaller amounts compared to the guys with a bigger amount?
I think how I look at it, it's a new product. So for me, let's say I put in I first of all, going back, there are, of course, the direct central bank purchasing of bonds, as you have put it, and then there's the brokerage side. So for me, I started from the brokerage side, the secondary market, where the costs are a little bit lower. So instead of 1%, I'm paying maybe around 0.25%. So I used my current broker with the CDSC account to purchase in the secondary market. So that's how I got in there, and I think that was more sustainable at the time. But this one now allowed me to directly deal with CBK. Obviously, you find a way to maybe offset that cost by another way. If it is holding it for an extended period of time, I think that is or reinvesting it once they pay out, that can do well for me. And then I think I was going back to the question of this. It is lending. And generally, the global economy, based on the whole economic outlook, has been sort of slowing down. Do you think with the direct lending, now that you can do it directly, of course, the retail numbers are showing that people are doing it directly. Is it likely to spur development in Kenya? Because as much as people are participating in it, you've seen in America, the debt ceiling is already at 33 trillion and probably a shutdown is looming at the end of this month, September. With that in mind, it means that the government will have to issue bonds severally just to pay back initial owners their interest payment, maybe the 6 months due or the 3 months due or the 1 year due or whatever. Is it like safe or relatively safe?
Traditionally, bonds has been classified as the safest investments that you'll ever find.
Yeah.
So one of the reasons backing this is because out of investors have been thinking that central banks don't default. So while for weaker economies, especially frontier economies, they have a higher chance of defaulting. Central bank, like let's say the Federal Reserve Bank of the US, has a almost zero chance of defaulting on its debt. So when you're thinking about the risks associated with investing in bonds, we tend to think of them as on one side defaulting. So we know that this Federal Reserve Bank of the US is not looking to default in the near future. It has the highest trust in the world, backed by the strongest economy in the world. But then for weaker economies like Kenya, we recently saw Ghana defaulting, right?
Yeah.
So if the debt situation gets really worse in a country, it may choose to either default or devaluate its currency. So for instance, we are seeing a very big risk coming up in Kenya over the next 1 year, where the Kenyan government is expected to pay over $2 billion worth of Eurobond. So if the Kenyan government defaults, then it might have to seek other solutions to try and repay that bond. And one of the most commonly used tools is basically printing money, using that money to buy dollars, and then using the dollars to pay the bond.
Okay.
So as a result of that, we risk a potential situation where the CBK would have to devalue the currency.
And that would mean higher inflation and all the ripple effects of it.
Yes, for the bond holder in Kenya, yes, you'd still be having your bond. The government would still pay you, but the money you will be paid with will be much, per se, I would say, worthless. That the purchasing power of that money will be way lower than the amount you invested initially.
They normally call it you will be paid at par.
Yes,
right?
you'll be paid the same amount.
If you invest at 100,000, you'll be paid yes at 100,000 or equivalent of it, but the value of it has decreased plus the interest that you will earn. So if it's 14%, whatever 14% on top of the 100, you might not really get much value from it in terms of spending capacity.
In simpler terms, let's say 100,000 shillings right now in Kenya is able to pay for, let's say, one semester worth of tuition in a Kenyan university. But then, if you wait, let's say, a couple of years down the line, and the currency has been devalued so much, then it may not be able to pay for that one semester of tuition. So in that case, the money is worthless.
Okay. Yeah. Now, in choosing bonds, for me, I look at it from the development side. So what I've been looking at, infrastructure bonds tend to do better. They have a higher subscription rate, or even over subscription, because people believe if the government of Kenya comes to list a bond and they want to build maybe a railway line, that one is a tangible infrastructural project which I can either ascertain to it or its value chain in the economy can generate or guarantee some returns to me. And I think that is why I kind of focus on the same. There are recurrent expenditures, which like the short-term T-bills, which of course they do offer good returns. But in regard to your risk assessment, you tend to. It has, at least I've seen the latest, around 90 to 95% subscription rate. By subscription is basically those who subscribe. If they list, let's say they want 20 million, people, let's say, put in, let's say, a bid of around 18 million or something like that. Do you factor such in terms of in your individual capacity maybe, or as an investor, in deciding which one to focus on or put in the bigger sum and the other maybe just a small amount?
Well, I would say that all bonds to me are literally the same as long as they are issued by the same institution, because they are backed by their ability to pay. So the credit rating of the government is what matters rather than where the money is going. So if the government has a good credit rating, then it will generally pay all the bonds the same way. So the key difference with the infrastructure bonds is because they were issued tax-free. So that's why there is a higher demand for infrastructure bonds, because you know that when your yield comes up, it's not being taxed.
Yeah, that is what I was into. That is why I like it, because you know there is no liability from it. Whatever is promised is what you get at par, and that is it. good that you mentioned credit ratings. I think we will oscillate between Kenya, Euro, maybe China, US in regards to bonds because typically they follow the same concept.
Yeah.
In US, last time I think almost 2 or 3 episodes ago, when Fitch downgraded them to A plus, there was let's say a dive in the yield of bonds. But so far, I've seen they are oscillating between 4.35 to 5 point something. That is from the long-term bonds, 20 years, 30 years, around 4.35. For the short term, around 5.4. Do you think the negative rating from the Fitch and all these financial and advisory services agencies do dampen the demand for them?
Yes, they do.
Now, considering the fact that inflation is coming down, I think the dollar is very strong as well. Maybe.
So I think I'll begin with the current rates. So right now, looking at US bonds, the most common yardstick is usually the 10-year bond. So the 10-year bond, as we speak right now, is giving a yield of 4.33%. So this means that this is the risk-free return across board. So if there is any other investment out there across the world that is not yielding 4.33%, then it's basically doing worse than everyone else. So if you don't want to take any meaningful risk, you don't want to basically go for risky assets, then the minimum you will get is 4.33%. So this means that every commercial bank out there, it should be giving return on deposits of around 4.33% or below, because the commercial banks can generally invest your deposits in the bond, then give you a return.
Okay.
Yeah. So if you look at the Kenya-centric situation, if the US is offering 4.33, means that any commercial bank can invest in that bond. So if you compare the Kenya shilling between the beginning of the year and today, we started at around 123 shillings to the dollar. As we speak today, it's around what? Is it 148?
Based on CBK rating,
CBK rate,
147. I think the dollar has sort of gained almost, or rather the Kenya shilling has lost almost 20% of its value year to date.
So this basically means that if you had invested in this US bond at the beginning of the year at 123, and then you hold for an year, let's say you earn the 4.33%, and then you convert your money back to Kenya shilling, then your return should be somewhere around 25 to 30%. So it basically means that the cost right now of money is around 25 to 30% for the year.
Okay.
So any return that you are looking to achieve should be within that range or above.
Now, it's interesting that you see bond is one of those very bulky names in the industry or the financial markets, but they do affect everything else. For example, the yield, when they were hitting almost 5.7 there about a month or so ago, gold was literally being dumped because, I mean, you are packing in your cash. Most, if you listen to a lot of, I think for those who tune into Bloomberg or even Yahoo Finance, you listen to a lot of fund managers. They're talking about putting their money in an asset which they literally do nothing, and they expect within 3 months, 6 months, 1 year, they are gaining almost 5% for the investors. But there is this risk. You remember early in the year when we had the financial crisis, most of the banks had similar problem. They had packed in their money, let's say, when the yields were very low at around 0 to 2.5. Yes. And now it's almost 5%, but based on how you, let's say the negative effect of it, I don't know if I'm putting this right, is you will only get that 0.1. So even if the yields go over time due to high interest rate regime like we are right now, it doesn't mean that you, as the person who bought it at 0.1, you will get any different. And that causes at least, I think, liquidity crisis for them, at least within the short term, should people want their money out as fast as possible.
The way it happened, when we had a lot of money flowing in the system during COVID. You remember when the US printed a lot of money, everyone had money, they were basically airdropping money to people. This is when they were getting $1,400 per household. So the banks had so much cash and they didn't know what to do with it. Businesses were not operating, they were not expanding during COVID and lockdowns. So you can't lend to businesses that are not operating. So the only reasonable way to make something out of the money they had was to invest in bonds.
Okay.
So the bonds were not yielding much. It was around 0.1, maximum 0.2%. So let's say you get into a bond contract worth, let's say, 10 years. So when now the central bank decides to raise interest rates, and within 1.5 year period, interest rates move from 0.1% to 5.5%, this basically raises the bond yields across board. So for any newly issued bond, it will be issuing a much higher yield. So on that account, if you have your bond and you want to sell it in the market, nobody will want to buy the bond that is paying you 0.2% when they can buy directly from the government and get 5.5%. So in order for you to sell that bond in the open market, you'd have to sell it at a loss. So if the bond is yielding 0.2%, in order for it to match the yield that this other bond is offering, which is, let's say, 5%, multiplied by its period, let's say 10 years, then you'd have to do 5% times 10 years and then subtract that from the initial bond that you had.
Okay.
So you'd literally be selling your bond at, let's say, 80% its value or even lower.
So what I'm getting from this, or what I understand, is that the higher the interest rate regime,
yes, the higher
the lower the prices that you will sell if you are looking to sell your bond that you are holding, right?
Yes.
But the yields will be high for those who are buying at the current price, right?
Yes.
Now, when the interest rate is coming down, it means that the prices of the bond will go up, but the yields will be decreasing.
Yes.
Very interesting, you know. It's complicated mathematics, but I think that is why hedge funds exist, I believe.
So what basically happened is that these commercial banks that were holding these bonds at par, they had customer deposits. So when they were due to report their earnings, which they do every 3 months, people realized that they are holding massive losses on their bond portfolios. So you know that this bank has this number of bonds. If the bank holds on to the bonds for the next 10 years, they will get the full value and the full yield. But then if they were forced to liquidate today, they would sell at cents on a dollar for each bond, which basically means that they were holding too much losses. So out of that fear, people started withdrawing money from their commercial banks. So when they went to withdraw money from the commercial banks, they basically forced the commercial banks to sell the bonds at a loss, which led to the collapse of the several banks such as Silicon Valley and so on. But then that loophole was sealed by the Fed when it created this facility where a bank can borrow against its bonds at par. So if a client is looking to withdraw money and the bank doesn't have money, the bank doesn't have to sell its existing bonds. So it would just give the bond, borrow money from the central bank at the par rate.
Okay.
So the bond would be valued as if the client held onto the bond for the next 10 years.
Now, there is this process which is known as repo. I'm sure you're familiar with it, and we have talked about it several times, when they intend to repurchase all the issued bonds so that maybe they can reissue it later on in time, probably to get more value from it. Maybe you can explain to it and how it affects the currency, particularly maybe to the dollar or something like that.
I'll try and refer to the recent comment by the CBK governor, Kamau Thuge.
Yes.
So he basically mentioned, I think it was earlier this week, that they are adjusting the Kenyan interest rates into variable rates. So the first action he did once he became central bank governor was to hike interest rates by a full 100 basis points from 9.5% to 10.5%. So this week he announced that they are adding variable rates, meaning that the central bank interest rates will move from 10.5% plus or minus 2.5%. So now interest rates in Kenya can range between 8% and a maximum limit of 13%.
Obviously, no commercial bank would go for 8. And I mean, there are few which are, I think one of the banks, I don't know if it's I&M, I may be mistaken, which said that they are looking to even lower their commercial lending rates. I think maybe they are really trying as a business strategy to have a very wide or deep balance sheet, just to make sure that they have like a good revenue stream from the interest payment of their customers, but also maintain the customer ability to repay the debts without, let's say, falling onto the non-performing loans.
So what's basically happening is that once the central bank sets that rate, currently it's 10.5, but there's an upper band to 13 and lower band to 8. So commercial banks, sometimes you run with excess capital, sometimes they will have less capital. So in order to meet the central bank requirements, every evening they have to participate in what you call the interbank market. So in the interbank market, it's basically the commercial banks lending against each other based on the set interest rate by the central bank. So if, let's say, Equity Bank has excess cash reserves, at the end of the day, it can lend to another bank, let's say KCB, at that rate, so that KCB can meet the requirements of the central bank. So they keep on lending against each other like that, and that influences the amount of money they have the following day to lend to the economy. So sometimes when the central bank is looking to manipulate the interest rates, it can do what you call a reverse repo. So it will basically borrow money from the interbank market, the excess money, at an interest rate. And once it borrows that money, it's also some form of a bond. Once it borrows that, then the central banks will have less money to lend in the economy, which basically narrows down on the inflation problem. So whenever there is excess cash, the central bank will do a reverse repo. And whenever there is less cash, then it will do a repo purchase program.
Okay.
Yeah.
So basically issuing money for the bonds that you hold.
Yeah, it will inject liquidity into the interbank market,
Yeah.
get the bonds out of the market, and now the commercial banks will lend to the economy.
Which equals to printing.
Basically.
Yes. I think that's a very in-depth analysis of it all.
Yeah.
Now, we have seen in the Asian markets that in regards to corporate bonds, some of the what was this infrastructural?
Yeah, we had
Evergrande.
and now there's another company. The second biggest real estate company in China is also in trouble.
Yes, I believe they had issued some significant bits of bonds to finance their plans in terms of city housing and obviously office spaces.
Yes.
Corporate bonds, what are some of the factors? Because I think when you are looking at government, there's some degree of certainty that they'll pay, and the government will put in measures to ensure that they do not have a negative credit rating. Because as we all are aware, governments will always increase their spending, and hardly do they look to decrease it. What are some of the factors to look at before you say, okay, let's say, I'm sure in Kenya we have seen the green bonds which have been listed in NSE here. What are some of the factors you look into before saying, let me put in some money on the bond, on this particular bond, and bond of this particular X or two companies?
Well, when it comes to bonds, investors will always invest in a bond based on its risk profile. For instance, if you invest in a bond in Argentina right now, it's way over 100%.
118 to be specific. 118%.
118%.
Yes.
So the only reason that you would go for that bond is looking for that yield. Okay. But then on the other side, you are taking a much bigger risk. So you realize generally across board that the top economies will have the lowest yields on bonds. That's the first economies. Then if you go to emerging markets bonds, they will have relatively higher yields. If you go to frontier economies, way even higher, and even smaller economies will have the highest, especially the ones in trouble will have the highest yields.
Okay.
So if, let's say, a central bank like Kenya, Uganda, Tanzania is looking to raise an amount of money through issuing bonds, it's basically telling guys or investors, lend us this money and we promise to pay at this date. So if investors are questioning that, if they are questioning your ability to repay that debt, then you'd have to offer them something higher than other markets. So you'd have to make it convincing for a person who was looking to invest in a US bond for them to go for the CBK bond. So in order to do that, you have to issue a higher yield. Okay. So the same case applies to corporates. So for a corporate to issue a bond, it's in need of capital. So you would have to convince people that for me to lend you my money, why should I give you my money instead of parking this money with the central bank, which is guaranteeing me, let's say, the current 16% for the 10-year. So corporate bonds will tend to offer higher yields compared to the central bank bonds, and that makes them quite appealing for investors. But then, if something bad was to happen to the company and it's unable to pay, then the investors will take the shorter end of the stick.
Now, I'm curious to know this. When, let's say you evaluate a company, will you apply the same rules as you are looking, let's say, to invest in their shareholding? Does the same rules apply? Because at the end of the day, you are looking to invest maybe for 5 years,
Yes.
or medium term, or 10.
So the way it works is that if you're investing in shares, you're taking a bigger risk because you're taking ownership of that company and everything that is exposed to that company, which could be on the upside or the downside. So if the company is doing badly, you lose your investment, your share value goes down. If it's doing well, your share value goes up. Okay? But then if you're investing in a bond, it's not based on the performance of the company. Yes, there is some form of proportion of risk from the performance of the company.
Yeah.
But in most cases, you will find that as a bondholder, you're given priority more than the shareholder.
I think that is the case of FTX. Not is it FTX or the other bank, Silicon Valley, whereby the shareholders in the market were told, well, you guys, you took a risk.
Yes.
It didn't work out.
Yes.
We are very sorry. But the bondholders
Yes.
and the depositors were given priority.
Yeah, they must be paid.
Yeah, that makes sense.
Yeah.
Now, on to the interesting part of it all. Now, do you think maybe with these green energy bonds, and I know you have your very strong opinions on climate change and everything, we have seen it being raised everywhere.
Yeah.
So I think obviously there is the corporate, there is the infrastructure, quite steady, has been tried and tested over time.
Yeah.
Do you think the emerging bonds within the green energy sector, with the good attractive yields that they do, is it something that you can put in for 30 years, or you'll be trying maybe 2 years at max 10 and then see how it fares out?
I think for a completely new dynamic in the markets, which is the green energy sector, it wouldn't make sense to make a very long-term bet because you don't know how it might develop. So we have seen some clawbacks happening in the US as well as the Eurozone concerning the transition to green energy. We saw the strikes happening in Netherlands, strikes happening in Spain, or fighting against these green energy initiatives. So if it's offering quite an attractive yield, it might make sense to invest in the short run rather than investing in the long run.
Because I think the next one that is coming is AI.
Yes. AI bonds.
AI bond is definitely coming. So something along that line, including Bitcoin or something like that. Now, right now to the US economies, and obviously a wrap up of what is happening at the moment, we are seeing automotive workers striking. And I think that is doing a number on the short-term yields. I think because it really glooms the economy. If right now it's 5 days on and there is still no, I think they have issued an ultimatum of by Friday 22nd that at least they should have a deal. Do you foresee that playing a part in today's speech by FOMC Powell?
In the last couple of meetings, the FOMC or the Fed has basically maintained a very strong opinion that they are an independent institution and they have a constitutional mandate to serve. So their constitutional mandate is to basically stabilize prices or basically fight inflation up to the 2% target. So that's their core mandate and everything else is secondary. So they have other mandates such as ensuring full employment, ensuring economic growth. So I think that's the key focus rather than on the small factors happening within the US economy.
Including
for instance, when the banks were collapsing sometime back in the year, the Fed did not care, just continued hiking interest rates to push inflation back to the 2% target. So the key concern today during the FOMC meeting will probably be the recent inflation reports, where inflation basically jumped from 3% to 3.2%, and then in August moved from 3.2 to 3.7%.
Even the core inflation, I think, has jumped to 0.3, 0.03. So obviously that will be in play. I think with the oil prices still going up. Yesterday we had this statement by Biden. I think emptying the SPR is not really out of the table. And I've been following the price of oil for at least 3 months now. And I think the impact that Saudi is doing in terms of cutting production is almost reaching its peak. Meaning that the highest it could go is maybe 95 for Brent and maybe 92, 93 for WTI.
I think we already saw 95 yesterday.
So because there are other countries which are still producing and beating or rather matching the already removed supply from these countries. Do you foresee maybe stabilization of the price to the normal we know of a barrel of oil around 80 to 90 thereabout?
I don't see any stability coming into oil in the next 6 months. Yeah, it's crazy, but it's happening. It's a war.
Okay.
I remember Biden visited Saudi Arabia, asked them for to increase oil output. The following day, they cut oil output.
Okay.
So what we are seeing is that Biden has been manipulating the SPR in order to narrow down on oil prices. So by basically drawing oil from the SPR and intervening between the natural forces of demand and supply by basically increasing supply in the market, he has been manipulating prices lower. So he kept doing that from the last year's high of $135 per barrel, kept pushing it down, and I think 3 months ago we saw it trading at around $71, $72 per barrel.
Okay.
But then around that time, this is when we had the Saudi Arabia, Russia, and the OPEC countries ganging up to cut oil output in order to stabilize prices, because if prices are going down, it's hurting them. So since then, they have been cutting and cutting and cutting, and the most recent announcement, where they cut by 1.3 million barrels per day and extended that for the next 3 months towards December, basically means that we are going to face a period where the oil producers are cutting production and global demand is rising. For instance, for Europe and US, we're heading into winter. So as we get into winter, the demand for gas, especially for heating homes, for manufacturing sector, it will continue rising, but supply is not rising. So those dynamics basically imply we should be seeing some higher prices.
Okay. I guess the reason why I'm bringing all this is because these are the factors that move the economy.
Yes.
And if the economy is moving to some degree, it means that one thing, the government has the ability from collecting revenue and obviously individual income to repay back investors. I think one of the key, let's say, outlier in US, I think you can invest from as low as 100. That is a tenth of the standard. I think it's almost $100,000 in terms of buying bonds, while in Kenya, I think the minimum for bonds is like, is it 50K?
William Ruto is asking for 3,000, my friend.
Okay.
Yeah, if you are on Akiba platform, the minimum you can invest in the bonds is 3,000.
Okay.
Basically, shows the kind of, I would call it what? The government is desperate for money. It's borrowing desperately from its citizens.
Now, how should you align yourself? You know, with trading, there are risks. So obviously people know there is there is a good chance of multiply effect from the market as well as losing it all. While this one, you will have to have faith and patience. And obviously importance is understanding the cost that you incur if you decide to cash out before the term of maturity.
So in an environment where the government is desperate for cash and it's borrowing more and more, we are seeing yields rising higher and higher. So if today you borrow the current rate, let me check just quickly. In Kenya, the three months bond is yielding 14.51%. The 10-year bond is yielding 16.71%. So if this yield rises to 21% or even higher, and you have already bought at this rate, when you are selling your bond before maturity, you will have to sell it at a loss. So you have to be prepared to hold it throughout the entire period. So if you buy a bond for, let's say, a 10-year bond, you have to be prepared to hold on to that bond for 10 years. So the real risk that we are facing as Kenyans investing in bonds is the inflation-adjusted return, or basically the inflation-adjusted yield. So while on one side, you might find this very attractive. Let's say you go for a 10-year bond and it's giving you 16.71% per year. So if the inflation is on the rise, for instance, last year I think we averaged around 9% inflation. This year, yes, it has come down to around 6.7%.
Which will spike in the next reading given the almost 30% hike in fuel prices.
So we could be seeing average prices. And you can track that from your own spending. You look at the amount of money you are spending at the same time last year, let's say on your consumer budget, and then compare with the same time this year and see how much that has changed. So if that consumption is, let's say, up 10 or 20%, which is what the CPI inflation measures, then you know that the money is losing value. So if the money is losing value at the rate of 10% and the government is yielding, let's say, 16%, then your real return is about 6%.
Yeah, that is where I was coming from. Like, if you do the calculation, it's more or less similar to the US, because US inflation is around 3.2 year on year.
Yes.
And then the yield is 4.35. So you are making around 1.5 to 2 on the higher side,
Yes,
at least as you invest, depending on how inflation goes. So I think that is very important to mention, so that, even though the numbers might be good,
yes,
the other factor is, if Argentina is giving 118,
yes,
the inflation rate is somewhere like 70%.
So here's the real picture. For the US, 10-year is 4.32%. So the current inflation rate officially is 3.7%. So you're basically earning around 0.5% in real return from that bond.
Yeah.
Assuming there are no transaction costs, there is no taxation on the yield. So around 0.4% on that return.
Yeah.
But then, if you hold on to that bond for the next 10 years, that real return is getting cumulative losses from the inflation.
If the inflation, let's say, goes up.
Yes. So when inflation goes up, it doesn't go back and then up and then back. So it's not like a step movement. It's a continuous increment.
Yeah.
So for instance, let's say you gained 5 kgs in 2021. So if you gain 4 kgs in 2022, it's not like you're losing weight. You're not.
Yeah.
So now you're up 9 kgs. So if that goes down in 2023, you gain 1 more kg, now you've gained even more. So the same thing applies to bonds. So if you invest into a 10-year bond and the cash shilling, let's say you invest 100,000 shillings, the cash shilling loses by, let's say, 7%. That is, average prices are up 7%. So now the purchasing power of your money is around 93K at the end of the year. So that 93K now gets another inflation for the next year. So if it's, let's say, another 7%, it goes down to 80-something percent. So by the time you get to 10 years, the real purchasing power of that 100K will be somewhere below 50K. So cumulatively, the amount of money you get at the end is losing value, and the yield that you're getting every year is also losing value due to inflation. So it's not that attractive. And for any young man, I would suggest you take more risks in the markets and find something that can give you a much higher yield, because you have more time. So if you are an elderly person, let's say you just retired at 65, you've had your life savings, you could maybe decide to park the life savings in a bond and then survive on the yield.
Yeah, that is what I was coming to.
Yeah.
It's a way to like how do we call it, a safety net for you,
Yeah.
and a good cash flow over a period of time.
Yes.
It's not like a magical multiple returns on it,
Yes.
but somewhere to pack it in a way that you will not be tempted to get it because of the punitive measures you will suffer, but the yield will keep you surviving.
Yeah.
And you are guaranteed some degree of salary, to put it in short,
Yes.
on a regular basis. I think that's my take home from, or what I learned from the bonds market itself.
So generally, in Wall Street, bonds are basically described as dumb money. Yeah, they describe it that way because you don't have to do anything. It feels like you're getting a consistent return, but it has a real use case, especially for pension funds.
Yeah.
So if you are an insurance fund or a pension fund, you have, let's say, this cohort of people that are your clients, and let's say you are working with a company like NSSF. They know that out of their clientele, they have 100,000 people who will be retiring next year. So they will require to get their money. So they don't necessarily get all their money, but they'll be getting this monthly stipend from their lifetime savings in that fund. So knowing this, the fund would not put the money in risky assets such as stocks, because a stock has this volatility risk where it can go up or down, or the market risk and so on. So in that case, the pension fund will take a certain amount of money, put this in a market, in a bond, and it will be guaranteed that at this period of time, the bond will yield this amount of money, and you will use this amount of money to give to this client. So if it's, let's say, an insurance company, it may also do the same. So after doing, let's say, their risk calculations, they can say, on average, in 2024, we're expecting this number of accidents or this number of people to be dying or to get sick, depending on the risk they cover. So once they get that number, they will know how much money to invest in a bond, so that by the time it's yielding, they will have that cash ready to handle those challenges.
I guess this topic is quite interesting nuances that, of course, we cannot cover it in one sitting.
Yes,
and I'm sure to all our listeners, you might have learned one or two things, but I hope we can be able to get maybe a bond trader in the market sometime to elaborate even further. But I believe that was very interesting, unless you have any closing remarks for today.
Yeah, my closing remarks, if you are, I would say a random number, if you are 35 and below, I think you have no business investing a lot of your capital in bonds. So it's good to have a good and widespread portfolio where you have different amounts in different asset classes.
True.
So you might want to learn early about bonds. So you might want to put something small in bonds so that you understand how it works and see the kind of returns in comparison to other asset classes. But then I would strongly recommend that you look at other sectors that you're knowledgeable about, especially investing in what you do, your skill, your business. And then look at these, I tend to view them as vehicles. So look to put your money in a vehicle that is moving faster than bonds. That way, you'll be taking a much higher risk, but on the other hand, the potential for you to get a good return that will help you in future increases several times fold.
And more importantly, cover the cost involved with the transaction that we started with.
Exactly.
That has been your bond episode, probably one, where we will definitely try to address some of the, of course, traditional investment schemes. I've been your host, Jesse. Remember to share, subscribe, like, and most importantly, put in your questions where you feel like you do not understand. You can always reach me on Twitter at OgolaJ4, at Rufas KE, at FX Pesa Official.
Yeah, the Champions League is back. What do you think will be the scoreline between Man United and Bayern?
A full jersey of CR7. Adios, guys.